Turning to the growth fund, I'd describe the year as solid. A 15% return from a portfolio of what we think are quite defensive assets is pleasing. Obviously, in a year where share markets are running strongly, investors might prefer that we perhaps were a bit more aggressive. It hasn't been our DNA for the last 18 years, and it's unlikely to be for the next. What we have created and what we're proud of is a fund that continues to distribute a strong annual dividend in the range there of 6 to 9%, with a unit price that's also increased by at least this amount on average over the last 10 years. So they're numbers that we're proud of. We think they stack up very well against other investment alternatives. Our best performers in 2014 are listed there, and these are companies that all contributed, as I said, strongly. They're companies that have very good, strong, recurring revenues, which is something that we're always looking for. I've used Macquarie Atlas as an example just to give a sense of what we do. We have a fairly good Macquarie Atlas, toll roads, quite a nice conservative business. We have a pretty good sense, and we do this for every company that we follow. There's probably 300 in our universe. We go through and we make sure that we have a pretty good feel for what cash we're going to get from these businesses over the next 5 years. And in the case of Macquarie Atlas, you can see there our 5-year forecasts. So what does that mean? Well, what that means is at the current share price, and it's important to make the observation that we bought the shares a lot cheaper than $3.40, but because we have investors coming into our fund on a regular basis, it's important that we're continually asking the question of whether we can deliver the returns from the current share price of $3.40 rather than from the historical cost. So we are constantly reassessing the value and the upside. We think the combination of the cash flows across the top line and our target exit price in 2018 give us that expected return of 15.5%. Now, 15.5% is probably okay. It's a good return with Macquarie Atlas, nice defensive toll roads. There are other businesses that we might be expecting more. So very much concerning us is the degree of confidence that we have in those numbers. It's very easy to put 5-year numbers up there. Obviously, business doesn't happen in a linear fashion, and there are shocks along the way. To give you a sense of the sort of analysis that we do at a high level, we can buy corporate bonds, and we can buy bonds at the moment in Hoyts, Alinta, Mile. That's corporate debt with hard fixed coupons and a hard maturity date. We need to make sure that whenever we buy an equity investment, that we're being compensated for the risk. In the case of Macquarie Atlas, we're comfortable that the 3, 4, 5% per annum benefit that we get from owning Macquarie Atlas is enough to compensate us for the risk of that investment. But we're doing that for each and every investment that we make, going through and making sure that our returns compare favourably. What is the degree of confidence that we have with the investments, and making that evaluation on every stock. So I might pause for a moment and just ask the guys to come up and take some questions. How do you handle currency exposure? Brad, I might let you do that one.
Sure. I think the key point here is, and when we get asked this question, the first thing to note is that in order to hedge currency from an equities perspective, it's not quite as clear cut. There is a cost involved, and when you start trying to predict the unpredictable cash flows of the equity markets, the cost becomes quite significant. So the answer is we don't hedge at all. We take the risk, and we do have UK exposure, US exposure, and New Zealand dollar exposure. And from our perspective, we're quite comfortable with the risk. And when we speak to investors, it seems to be the same way. We don't have a view either way on any of the currencies, but what we do know is that if we try and take a view, invariably we'll end up spending a lot trying to hedge that out, and then we end up diluting the returns of the actual investment.
Yeah, I think we're quite comfortable. In summary, we're quite comfortable having some pound and US dollar exposure in the portfolio. This is one that we're getting a bit at the moment in terms of individual stocks and the flurry of IPOs, and maybe just a comment on the our participation and how we're looking and thinking about IPOs. Do you want to start?
Sure. I guess, there's been plenty of IPOs that have come across all three of our desks every week. It seems like, 2 or 3 each a week, and we not only are we managing the existing stocks that we look at, we're now given these businesses which, most cases, we're seeing for the very first time. And the investment banks say to us, guys, you need to tell us within 3 or 4 days whether or not you want to invest in this product. From our perspective, we see an IPO as an expansion of our universe. We don't look at that 3 days as the necessary time for us to make the decision. We can't make a decision that quickly. We typically like to do due diligence which lasts 3 days, 3 weeks, 3 months and 3 years as we build up that knowledge base and then have the power to invest with that knowledge base in the business. So while the IPOs are coming and there's often maybe a quick buck or maybe not a quick buck to be made, from our perspective it's much more the benefit is the expansion of our universe and the ability to invest in more potential businesses down the road.
Yeah, I mean, I can't tell you the number of conversations we've had over the last 2 months with managing directors of businesses that are floating. They've been involved in the business for 30 years, 40 years. The investment bank wheels them in and asks us to make a decision in an hour. So, our normal refrain is to say, congratulations on having achieved what you've done, and we look forward to continuing to get to know and understand your business. And we do. And as we say to these companies, the date of the IPO just happens to be one point in time at which you have the opportunity to buy the company. Yes, of course, there'll be some companies that trade higher and you have to pay a little bit more 6 months later, but you'll certainly have a bit more certainty about their outcomes. There are a lot of companies that won't reach that price, or indeed if they are trading above there, will quickly come back to earth. So very few of those IPOs are businesses where we've been given the time and allowed the access and due diligence that we need. And interestingly, the response that we get from the companies is often really quite positive. Delighted that you guys are actually keen to take a proper interest in us. Have been amazed at the process where people put their hands up, institutions put their hands up for hundreds of millions of dollars on one meeting, and that's effectively the superannuation savings of Australians. It's a unique process, and it's one that we think we handle pretty well. So I might open it up for general questions if there are any. Why don't I flick back to that, and if there are any questions on the performance or on the portfolio, maybe now's the time to ask it.
Are there any preferred sectors that you like to invest in or you like at the moment?
Yeah.
And probably with that, do you normally just pick one stock within that sector?
That's a great question. And the answer is yes, there are preferred sectors, and we battle occasionally picking more than one stock in a sector. So maybe I'll let Silvo address some of those.
I mean, as you can see there on the presentation, we've got two of our biggest investments in the healthcare space. It's a space we really like because typically the assets are got a very predictable revenue and profit stream underpinned by strong organic growth and demand for those services. And the battle and the challenge is always to try and pick the best stock in the sector. So we tend to sort of gravitate towards industries and businesses where there's a high degree of predictability around revenue and profits, and as in the case of Macquarie Atlas, where it allows us to sort of make forecasts as to the future revenue and profits that business or assets going to be able to generate.
We love software businesses. The technology one, the accounting software business, love a business that sits in the middle of an organisation's operations. Very difficult to churn off it. Very difficult, as you all know, to change your enterprise system. So we love those. There are a couple of floats that have just come out of New Zealand. We've just talked about floats, but a couple of software businesses out of New Zealand that we're looking closely at because we really like that essential. The software is an essential service. I'm not talking about stuff that's sort of a bit discretionary, but stuff that really sits, right in the heart of the organisation. We love that. On the question of companies in sectors, healthcare is a great example where, with the recent Healthscope IPO, grappling with that business alongside Ramsay has been a really interesting process and an interesting decision. It's been priced a little bit cheaper than Ramsay, but not much cheaper, and they are two quite different portfolios. So, but if we do, get comfortable going back to our expectations of return, if we can see cash flows, a share price exit that's going to be well above where we're buying it, we happen to have another stock in that sector, we'll buy it as well. Any other questions? Well, if that's all, we'll move on to the credit business. Thanks, guys. If I could invite Josh and Andrew to give us an update on the credit business.
Thank you all very much for taking the time to be here with us this evening. The credit team and I are very pleased to report a return for the last financial year of 14%. This also gives us a return since inception, nearly 4.5 years ago now, an annual average return of 12%. Both these returns are after management fees but before performance fees. But even after all fees, the annual return since inception comes in at over 11% for an investor who invested with us on day one. And whilst we're very pleased with these returns, we also are aware that many investors invest in the credit fund for an income stream. And indeed, one of our stated objectives is to provide investors with a steady and reliable income stream over the period. And to that end, we're pleased for this year to announce a cents per unit distribution of 9.3 cents, giving a distribution yield of 8.2% for this financial year. And looking back over the last 4 years as well, you can see that to date we're pleased to report that we have provided a steady and reliable income stream. And on a forward-looking basis as well, we certainly looks like we are able to provide that for the next few years as well. Looking at performance attribution, as we mentioned, 14% for the last financial year, made up of 8.2% coming from a distributable yield and 5.8% coming from growth in the portfolio. Going back over the last 3 years and since inception as well, so there's been a good mix of distributions, as we mentioned, and also growth in the portfolio. On a forward-looking basis, certainly for the next year or two, we anticipate that the bulk of these returns will be coming from distributions with less input from growth in the portfolio, but still achieving our target returns of RBA cash rate plus 3 to 5% per annum. In the last 12 months, it's also been a period of innovation and exciting opportunities in the credit fund. Some of these opportunities have been coming into the credit fund itself, and some have been of a size or the nature of an investment whereby it made sense to offer them also through a special purpose vehicle opportunity which we offer to our investors. To date, there's been 4 of these SPV opportunities, all of them providing returns in the realm of expected return of 9 to 14% after all fees. And on a forward-looking basis, we anticipate that for the rest of the calendar year, there'll be another 2 of these, hopefully more, which we'll certainly be in touch with our investors about in due course. So thanks very much for all taking the time to be here this evening, and thanks very much for your ongoing support, and I look forward to fielding some questions from you all as well.
Must have some questions for Josh and Andrew.
How often do you plan to report on the performance of the SPVs?
We anticipate being able to report on them on a semi-annual basis. Some of the distributions will be a little more frequent than that, quarterly, but we anticipate at least semi-annually you'll be getting statements along the way.
And the second question is the quality of the assets in your credit fund portfolio. Are you giving up quality to continue to achieve the yield you're after, or the yield that you've got?
Yeah, thanks.
It looks to me a little bit as though you are.
I think the starting point is that the capital security is the most important thing, and so I think over time we certainly expect the return profile not to replicate the historic return profile and chase those returns. I think the development of the SPV business has been an interesting discussion internally, because it's one that's been developed around, well, what is the risk profile of the credit fund and what is an SPV and does it actually fit in the credit fund? And so I think that income and capital stability is something that's paramount, and the SPVs and the credit and the growth fund, for that matter, still focus on capital security. But that 3 to 5% is something that we think is appropriate through the cycle as a risk profile for that type of investor.
Just to be clear, we certainly don't. We're very pleased with the returns we've achieved to date, but I think we've been very clear in the newsletter that on an ongoing basis, those sort of returns aren't sustainable. Our target return is RBA cash rate plus 3 to 5% in the credit fund, and we feel very comfortable that with an appropriate level of risk we can continue to achieve those returns. As we mentioned, the SPVs have been, some of the opportunities were not appropriate for the credit fund, some were, but at a size that was greater than the credit fund was willing to participate. We took a portfolio approach, and that's why the SPV business was born, to take advantage of these opportunities. We still felt were great returns for the risk, but perhaps not the right risk-return trade-off adjusted for the credit fund, per se.
I think probably just one quick other point is that historically the fund was very concentrated, or the opportunity set was really in that bank capital structure trade that was, in the depths of the GFC. I think over time it's expanded into more corporate and infrastructure-based sectors, where we see that cash flow stream and the stability of that cash flow stream. So I think the fund is diversified by nature of finding those opportunities. It's not a reflection of trying to take more risk and chase yield.
It might be a good segue. Sorry, Jeff, you go.
In your space, the red flags seem to have moved from European banks to residential property. Do you have any exposure to this area, and how much?
So the breakdown of the fund, about 56% of the fund is still in financials, and the bulk of that is still in banks. There are direct investments in mortgages, which make another 7 to 8% of the fund. In terms of the risk profile of what we're investing in, it's certainly very low risk. It's akin to bank type risk that we're investing in. The Australian market is going through a period of buoyancy through the low interest rate cycle and the stimulation that brings. And we do see at some stage that property prices will, they're very buoyant at the moment, and they will go through a period of adjustment as the rate cycle adjusts. And we're certainly stressing for that scenario when we make an investment.
Certainly, Jeff, at an investment committee level, we're applying some pretty catastrophic stress tests to the numbers. Now, the black swan event, is certainly going to hurt the banks, the Australian banks. But the sort of analysis that we do when the guys put up a security in terms of what needs to happen to house prices, what needs to happen to interest rates, unemployment, before we're in trouble, we are stress testing it quite keenly. I might just turn to that question which flows a little bit from Laurie's point, which is, not so much the view on rates, because I'm sure everyone's got a different view on rates, but more interesting for us is how does it impact on the fund's performance, whether rates go up or down. I think as an investor, that's a sort of an interesting question. So.
Yeah, with regard to interest rates, we've been of the view that for some time now that rates would be lower for longer than the market had anticipated. We've certainly discussed that around the desk for the last 2 or 3 years, and we've been positioned for that. But by and large, we're not a fund that takes interest rate risk. To put it in perspective, most fixed income funds that one would think about to take on a duration risk that might be in the realm of, say, 3 to 5 years, which means that for every 100 basis point move higher or lower, they will lose 3 to 5% of their value. We try to go with about a 50% fixed and floating mix in the portfolio, and to date we've been leaning a little bit towards some floating now. after having a slightly heavier weighting towards fixed for the last few years. Having said that, our duration at the moment is only about 1.6 years, which means for every 100 basis points that the market goes up or down in terms of interest rates, our fund will only go up or down by 1.6%. So it's a very low, has a very low exposure to interest rates. And our feeling is that in the current environment, it's probably prudent to be lowering that even further down to perhaps about 1 year. There is a trade-off, because when you take on a fixed rate security today, it is a yield pickup, a slight yield pickup, above what you get if you take a floating rate security in terms of cash yield. So we're balancing the demand for cash yield in the current year and the need to provide a reliable and high income stream with the risk in the portfolio. Having said that, all things being equal, we feel that where we are on rates, and as Ivan mentioned earlier, if the Australian dollar falls, there could be inflation feeding through. We're very conscious of that, and we're moving ourselves further towards floating such that any spike in interest rates is likely to have a very minimal impact on the portfolio.
Other questions? No? Good. Thanks, guys.
Thank you.
Susie, for some closing remarks.
I just wanted to start by saying there's a lot of work that goes on behind the scenes to get us here tonight. Tireless efforts by everyone at River, and especially Zoe, Nadia, Paul, Tom. So thank you from Barry and myself. I'm grateful for many things in life, but at the moment I'm grateful that I can actually read this because I need glasses. That's just evolved in the last 6 months. I really wanted to conclude on bringing it back to why we do the things we do at River Capital. Last week, Barry and I were at the launch of one of my favourite charities called Jewish Aid, which is now called Stand Up. At the launch, they spoke about being an upstander, not a bystander in the community. From my perspective, this really says it all. For Barry and I, 18 years ago, we created River Capital. I have to admit, we don't often take the time to reflect and pause and appreciate what we have created, and more importantly, why it's so unique. For us and for the rest of our incredible team at River, it's all about standing up. It's about leading by example and doing our best, trying to make a difference in the spaces that we're passionate about, whether that be the growth fund, the credit fund, the admin or finance team. One thing I can assure you all is that we're motivated each day in whatever we're doing to conduct ourselves with humility, respect, and have a commitment to excellence in all that we do. As Barry said in our recent investor letter, we take the responsibility of managing your money very seriously. And if anyone knows this, it's me, because I live with him 24/7. And I have to say that every year I'm like, is this really what we want to be doing? And it is what we want to do, and we're really proud of it. We've spent some time recently trying to put on paper why we are different and what are in fact the core values and ethos of our group. I have to acknowledge and thank Josh Ackman for starting the conversation, as it was he that said it's so important to recognise and articulate this for all our stakeholders, because we are different, we think differently and behave differently. So this is really just the preamble. It goes for about two more pages, but it's just a little sneak peek that I wanted to share with you. Someone recently said to me, from small things, big things grow. I hope this is true in everything that we do at River Capital, and not just with your capital. I just made that up, that's quite cool. These words behind me, I feel reflect our journey at River and capture the essence of who we are and what we are trying to achieve. The River Capital way is about the way we do things here and why. We've also spent the last few months working on redesigning our website to make it very spiffy and investor friendly and informative. The new site will go live, I think now, so we hope you really enjoy it. Finally, as Barry mentioned earlier, in these extremely volatile and distressing times around our world, it's vital to remember what really matters and remain confident and optimistic about the future. I'd like to conclude by saying we will, as we always have, continue to act responsibly, patiently, and will conduct ourselves with personal and professional integrity in all that we do. We have an uncompromising commitment to investor and community success, and we look forward to working with you all in the coming years. Thank you.